What a difference a year makes. At the beginning of 2016, the price of crude oil was at a 12-year low and many energy companies looked crippled. Since then, however, it's recovered dramatically. It's more than doubled. And those companies, we've learned an awful lot about them, about how nimble they can be. To discuss this, I'm joined by Randy Cutler, one of our senior credit analysts who covers the energy sector, and Tom Ackermans, an equity research analyst for the sector as well. So a question to both of you, first of all. Can you put into context how these changing conditions have affected the companies that that you cover? Randy, perhaps with you first of all.
Sure. So over the last 2 years, there's been 100 bankruptcies in the energy companies in my broad universe, and of which 30 are public companies. So the majority would be privates or bank loan finance companies, but still 30 is a large number. And that certainly had some spillover into the broader high yield markets, where you certainly saw negative returns in 2014, but again, or excuse me, in 2015, but 2016 really pretty extraordinarily strong returns given the recovery in oil prices and the recovery in the distressed energy companies, where I saw returns of up to 50 to 300% returns last year in some of my high yield credits.
Extraordinary, and what a change of fortunes that you must have seen as well, Tom.
Yeah, exactly. I think if you look back at the European oil companies and go back 2 years, even 3 years, when oil was above $100, the general view back then was that these companies need ever higher oil prices to remain profitable and to deliver value for shareholders. And when the price of oil first started going down, there was a fear that they wouldn't be able to adapt to the new environment, to cut costs fast enough, to cut capex fast enough. But in reality, they've actually adapted very quickly by cutting investment aggressively, by cutting operating costs aggressively. So for many of them,
in a surprising way?
Yes, much quicker than the market thought they could. And so in many ways, some of these companies now look better at $60 oil, given the changes they've made, than they did in 2014.
Survival of the fittest, in a sense, the ones that remain of yours. How do you think they're placed for the current conditions, Randy? Again,
I see my coverage universe generally with improving credit trends, where I see cash flow growing by anywhere from 40 to 60% from 16 over to 17. And I see balance sheets certainly deleveraging at least a turn, which is one way we measure leverage. That's coming from higher commodity prices, lower costs, and then also the ability of these companies to tap into the equity markets to finance growth, which has been definitely a surprise.
Now, there are differences between the companies that you cover. Yours tend to be smaller, medium-sized organisations in the States, and Tom, yours tend to be the majors here in Europe. And it's a different picture for you, isn't it?
Yeah, that's right. I think the approach for the upcoming year is very much a continuation of what we saw over the last year as well. More cost-cutting, consolidating, trying to improve cash flow where possible. There will be a clear benefit from higher oil prices and to a certain extent also slightly better gas prices. So the companies will be able to improve and will be able to start reducing the levels of debt that they are carrying. We are seeing small add-on acquisitions being made to strengthen portfolios, and again, that's benefiting from some of the weakness that the smaller players are still experiencing. So there are some opportunistic acquisitions out there, but the main thing is continued capital discipline, protecting the dividends, showing to investors that they can actually afford the dividends they're currently paying out.
Now, both of you spend a lot of time delving into the detail of these companies, speaking to the bosses. What insight can you offer based on the contact that you have and the detailed knowledge that you have that might differ from the received wisdom in the market about where these companies are going? Tom, if I could start with you.
I think we're at a stage where things really need to go right for that recovery to continue. Over the next couple of months, I think we'll see a confirmation of the OPEC cuts and some of the non-OPEC players as well. Shipments from the Middle East into the US should be going down, and that should lead to a normalization of inventories where we've had a big overhang and the market is waiting for that to clear. Then we get back to a normal market, and then we kind of start worrying again about things like disruption, about a rapid recovery in US production growth. We think that's probably again going to overshoot expectations. Producers, and this includes some of Randy's companies, are very quickly adding rigs back into the market again. They're looking to grow production again.
An interesting time to be covering the sector. Randy and Tom, thank you both very much indeed. And thank you for watching.
投资一定有风险，基金投资有赚有赔。申购前应详阅公开说明书或投资人须知。